Shell reported $6.9 billion in underlying earnings for the first quarter of 2026, 24% above the same period last year, and more than double the $3.3 billion posted in Q4 2025. Analysts had penciled in $6.36 billion. Shell beat every line. Then its shares fell over 2% on open. The FTSE 100 started the session in negative territory, weighed by the oil majors. Shell and BP both traded lower, even as their earnings told a different story. The energy sector had been one of the strongest performers since the Iran war pushed Brent crude above $126 a barrel just weeks ago, a 4-year high. That surge drove the earnings Shell reported today. But by the time those numbers landed, the market had already moved on to the next question. Brent slipped below $100 a barrel during Thursday's session. Reports of a possible U.S.-Iran ceasefire had been circulating since Wednesday, when global equity markets surged on the optimism. The FTSE 100, which had rallied sharply on peace deal hopes, gave back some of those gains as oil traders began pricing in a scenario where the Strait of Hormuz reopens. Logistics giant Maersk said reopening the strait would have limited near-term impact on cargo flows, but the oil market moved anyway. Stock markets broadly rose as crude fell, a clear split between what equities want and what energy stocks need. JD Sports added a different layer to the session. The retailer reported a 12% fall in pre-tax profit and warned that muted market growth lies ahead, citing the Iran war's drag on consumer confidence and rising unemployment among its core youth demographic. Construction data released the same day showed the UK sector contracted to a PMI of 39.7 in April, down from 45.6 in March, one of the sharpest cost-driven collapses in nearly 30 years. Shell's profits came from the same war that is hollowing out the rest of the economy. That tension ran through the entire session. The mechanism behind Shell share decline runs through oil price expectations, not reported earnings. Shell's $6.9 billion result was built on Brent trading above $110 for most of Q1. By Thursday morning, Brent was below $100. The earnings figure was already history. What the market was pricing was Q2, and Q2 looks different. A countersignal tightens this. Shell shares have been one of the top performers in the FTSE 100 since the Iran war began. Much of the good news was already in the price. Buying Shell at the earnings announcement meant paying for profits that had already been anticipated and, in part, already reflected in the stock's run-up. The $6.9 billion beat expectations, but it did not beat what the market had already embedded in the share price over the preceding weeks. There is a complicating condition. The Iran peace deal, if confirmed, removes the supply disruption that drove energy prices to multi-year highs. But Shell's management noted war damage to its own output, and the company is actively buying back shares, signaling confidence. The buyback announcement should, in most readings, be a floor for the share price. That it didn't prevent Thursday's decline is the unresolved threat. Shell is distributing capital at a record pace, while investors are exiting at record profit levels. Both are happening simultaneously. One of them is wrong about the next 12 months. The historical parallel is Q2 2022. Shell and BP reported peak profits in the months following Russia's invasion of Ukraine, and both stocks fell on earnings as Brent began retreating from its $130 spike. Shell's share price peaked in May 2022 and declined for the following 6 months, even as profits remained elevated. The earnings cycle and the commodity cycle had diverged. Oil prices peaked first, then pulled back, then dragged the share prices down, with a 1-quarter lag on the income statement. If the current Iran war follows that template, Shell's Q2 results, due August, could show further improvement over Q1, but the share price may price in the oil decline now. Continuation of this thesis requires Brent holding below $100 as peace deal optimism persists, and Shell's Q2 guidance remaining strong enough to sustain buyback commitments. That combination, lower oil, stable buybacks, earnings still elevated, is the window in which Shell's share price stays under pressure despite good results. The breakdown scenario is a collapse of ceasefire talks. If the US-Iran deal fails and Brent returns above $110, the trade reverses sharply. Shell's earnings would be revised upward, the sell-off on today's results would look like an overreaction, and energy stocks would lead the FTSE 100 recovery. That outcome would also confirm today's share decline as a short-term positioning reset rather than a structural re-rating. The single number to track tomorrow is Brent's response to any confirmed ceasefire language out of Tehran. Shell closed today at 3,135p. If Brent stabilizes between $95 and $100 on a confirmed deal, Shell's share price faces further near-term pressure. The earnings peak is visible, and the commodity tailwind is fading. If talks collapse and oil spikes, the Q2 earnings setup looks better than today's share price implies. The question Thursday session left open is whether Shell is a buyback story or an oil story. The answer depends on a negotiation that neither Shell nor its investors control. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.